When most people think of investing, they picture the hustle and bustle of the public markets, or, more specifically, the buying and selling of stocks and bonds on well-known exchanges like the New York Stock Exchange, Nasdaq, and other regional exchanges. But new opportunities are now opening for some investors, which can be just as crucial for building a well-diversified, long-term investment strategy. Introducing private markets. Simply put, private markets involve investments that aren't traded on public exchanges. Instead, transactions in private markets are negotiated directly between investors and businesses, often facilitated through private funds. Private markets offer a significant opportunity for investors worldwide, as nearly 90% of businesses with $100 million or more in revenue are privately owned. Well-known private market strategies include private equity, private credit, real estate, and infrastructure. Investments in private markets are frequently structured through a limited partnership. In this arrangement, limited partners, or LPs, provide the capital for investment. Common LPs can include sovereign wealth funds, endowments, and high net worth individuals. These investors pool their resources to create a fund which is managed by a general partner, or GP. GPs are the experts who manage that capital, selecting and overseeing the investments to drive returns. The funds they manage typically have a predetermined lifespan of around 10 years, during which time the GP will aim to invest the fund, generate returns, and distribute capital back to LPs. Given the extended duration and illiquidity associated with a 10-year commitment, private market investors typically seek returns that exceed those available in more liquid public markets. High-quality GPs, with the ability to make and exit investments over a longer time horizon, have historically outperformed traditional public equity investments.
Ladies and gentlemen, welcome and thank you for joining us in this new series on ebnet.stream called Inside Private Markets. I'm extremely excited to be hosting this series, what I believe is an incredibly important topic for all of us in South Africa as investors, both as individuals and as trustees of retirement funds. South Africa only invests 2 to 3% of retirement fund capital into our private markets. Internationally, that number is in excess of 20%. Why is that so different? In order to deal with many of the problems that we have in South Africa, like unemployment, inequality, etc., education, we have to invest at grassroots level. We need to direct private capital to help grow and develop South Africa for all. That allows us to also generate opportunity to produce good returns for all members of retirement funds into the future, ensuring that they can retire comfortably. It simply makes sense. Yes, it's not without risks, and that's why we are holding this 12-episode podcast in order to help you understand and identify both the good and the bad of private market investing so that you can make smart choices. I'd like to take this opportunity to now thank Old Mutual Alternative Investments, who have sponsored this series so that we can bring it to you for free.
Progress doesn't happen overnight. It's built deliberately, patiently over time. At Old Mutual Alternative Investments, we invest where capital can do more than grow, where it can build. We finance infrastructure that keeps economies moving, energy that powers homes and industry, schools that educate future generations, businesses that create jobs and resilience. Because behind every asset is a human outcome. A light switched on, a classroom filled, a community connected. We manage capital across private markets with one clear belief. Long-term returns and long-term impact are not opposing goals. They are inseparable. This is investing with purpose, with discipline, with conviction. turning Africa's structural challenges into investable opportunities and patient capital into lasting progress. Old Mutual Alternative Investments, building real assets, creating real outcomes.
Ladies and gentlemen, welcome to the first episode in the 12-episode series called Inside Private Markets, sponsored by Old Mutual Alternative Investments. I'm delighted to be joined today by someone who shares a passion for private markets like I do, Naveen Lala, a client director at Old Mutual Alternative Investments. Naveen, thank you for joining us and welcome. How are you?
Yeah, good on you, Leon. Thank you. Lovely to be here.
Yes, good to have you with us. When I say we share a passion, I believe that private markets is critical to the success, ultimately, of South Africa, but not everyone understands it all that well. I've often heard you talking about one of your strengths is decoding private markets for your customers. Explain to me why you feel that.
I think private markets play a critical role, and you're 100% right with that point. It's not just about investing in funds, exiting them, turning them around. It's about growing jobs, growing the economy, impacting lives, and making real changes. I think it's an ideal asset class where you can not only earn super returns, but also have capital allocated as a force for good.
So you've been at Old Mutual in this role since 2023, the start of 23. So that's just over 2 years.
3 years, yeah.
3 years. And you are engaging with institutional customers, so pension funds and their consultants, specifically on private market type investments. How have you found the level of knowledge generally in the market, both those that you've engaged and had success with, plus those that perhaps you haven't had success with?
So it's a mixed bag where you've got some really sophisticated pension funds and asset consultants that have been investing in private markets for many years. However, Regulation 28 only really permitted allocations to private assets in a meaningful way since 2023. So it's still very early days. It's an asset class that investors are less familiar with. And like all things new, it comes with a learning curve. And a lot of our investors are going through this learning curve. And I think it's podcasts like this and conversations like this where we can make it more familiar. And this will be, I think, in a couple of years, in fact, a mainstream asset class. That's a cornerstone of all portfolios.
And that's exactly the objective of this podcast, is to get inside private markets, to give people a better understanding of what is not just an important opportunity for South Africa, but a great opportunity for investors to ultimately deliver returns and manage risk, whether they're an individual or a pension fund catering for members. Before you joined Old Mutual, you were at RMB.
Yeah.
Also in private market field?
It was alternative investments, where it was funds of hedge funds. But prior to that, at the asset manager, Ashburton, at the onset, it started as an alternative investment manager with asset classes like private equity, renewable energy, private debt, etc.
And when you, whether it was the start of your career or not, I can't remember, but when you worked in a multi-manager field as a manager research analyst, in those days, there wasn't really private markets even considered. So has the market developed that much, and why was private markets not really considered back then?
Well, private markets weren't considered because there were regulatory constraints. Listed equities are a great asset class, and investors didn't really need to look elsewhere. And now today, fast forward today, you've got issues where you've got a shrinking listed universe, which is a global phenomenon. So I know the JSE in those days when we started our careers, I think it was in excess of 1,000 listed companies. Today it's around 300 at best. We know that the US markets have been hitting new highs over the years, and it seems as if it's been an almost one-way bet. So if you look at the index, it's just been going just astronomically higher. But if you look at the number of counters on those indices, like the S&P 500, in the mid-90s, it peaked at over 7,000 listed companies. Today, it's about 3,700. 3,700 is still a hell of a lot. But it's almost half of what it used to be at its peak. And that's just been a global phenomenon.
But it's an incredibly important point that you raise, because South Africa has a concentration of asset managers. The top 10 asset managers manage something like 60% of the total wealth in the country. And at their size, with the shrinking JSE and the lack of IPOs, it's quite difficult to invest beyond the top 40 stocks without taking serious concentration or holdings within listed companies. So finding other avenues, other investment opportunities, be it smaller stocks, but then you've got to have the right size to be able to invest in that, or alternatively, private markets becomes a necessity from an investment perspective. But not just that, private markets provides what to our country? Why is it so important within the context of our economy?
So private markets in general are growth in nature. And it's businesses that grow the economy and contributes to GDP growth. So businesses grow by producing products and services. And as businesses grow, they're able to employ more people. Employing more people has many benefits, where it increases consumer demand, which increases demand for those goods and services to be produced, and it also adds to the fiscus, so from tax receipts. And with higher employment, you have the opportunity, people have the opportunity to be able to improve their standard of living. And I think private markets play an important role in providing critical funding and capital to help these businesses grow.
So I was in a webinar this morning with Dr. Franz Cronier, private clients, and they were speaking to the fact that in order to create jobs, we need to be growing the economy by a good 4 to 5% per annum. And the only way to do that is to significantly increase fixed investment in the country to multiples of where we are right now. And that's what private markets ultimately is. It's about building factories, creating actual jobs for people that helps grow the economy at the end of the day. Is that correct?
Yes, absolutely. I think if the fixed investment or fixed capital formation he's referring to, I think speaks directly to infrastructure. And infrastructure is the lungs of an economy. It's difficult to produce goods and run a business without power. And we've had a power deficit in South Africa for I think pretty much 15 odd years. We've had market failures in the energy space, in rail, ports, logistics. So private markets have played an important role in being able to address these market failures. Through that, it's created an opportunity to invest in fantastic infrastructure assets where it has long-term, it's a great long-term asset that is well suited to pension funds and their long-term liabilities.
So let's unpack some of the terminology for the audience. So we talk about private markets. First question, what is the difference between private market and public market, or unlisted and listed?
Sure. So we're familiar with listed markets. You can buy companies or indices of the JSE or the S&P 500, and similarly to on the bond market. So that's what I've described now. It's buying equities or buying bonds or debt. Private markets are the same. You're buying private equity or private debt. And the private equity could be in private equity infrastructure, and the debt similar. The big difference is that you're not buying it off an exchange. These assets are privately held by private owners, And when they require capital to expand their businesses, listing is an option, but typically it's the last option because giving away equity is an expensive form of financing, and they don't typically want to give away control. So typically they'd want to look for debt as its first point of call, and we coexist well on the private debt side with the banks. So we're able to fund alongside banks to these private businesses, and often we're able to provide more tailored solutions that are better suited to these businesses and to be able to partner with them so they can grow.
So if I take our business, ICTS, which is a mid-sized financial services business, it's privately held.
Yeah.
If we wanted to raise capital to expand, we could speak to a private market asset manager, and if they're raising or if they have capital to deploy, there might be an opportunity to borrow, so have some debt through that structure, or alternatively for them to become a shareholder and receive capital in the form of equity, as a simple example. Am I correct?
Yes, that's dead right.
Okay, now, when we talk about private markets, I throw private markets around just as a term all the time. Private equity is included, private debt, infrastructure.
Yes, and I'd add real estate to that.
What is mezzanine capital?
So if you think about the way businesses are funded, capital forms either, the main pieces are equity financed, where the owner would put in their capital and own a portion or own the business, or it could be debt financed. And in between, there's different types of capital tiers. So mezzanine sits in the middle between equity and debt. So it has debt-like features, but often with returns that are not too far off with equities.
So explain then the difference between private equity and debt versus then this term infrastructure. Why do we have this term infrastructure? What's the difference there?
So private equity, and within private equity, there's a few other genres. So there would be, if you think of a lot of these tech businesses that have started in the US, Sequoia Capital being one of the well-known names for that, where they've invested in small businesses that were startups without revenues and there were ideas. And fast forward 10, 20 years, some of them have become the largest listed companies in the world. So you'd go through this. That piece would be venture capital, investing or financing. And within that, there'd be early stage, seed, and various series rounds. And then you'd get your private equity. So the first part has a lot more risk. Your failure rates are high, but the returns are phenomenal if you get it right. So that's for a very specific type of investor that has that appetite. And then you've got slightly more mature businesses, but still growth businesses in the form of private equity growth. And those are businesses that now need more capital that the venture capital guys can't provide. And there's lots of examples. We play in that growth space. And then there's buyout, where you're buying more mature businesses. And in that life cycle of a business, the IPO would be the next stage. So if you look at that transition or that progression, the IPO and listed part, when a company is listed, the bulk of its returns in terms of the massive rate of change has occurred prior to it listing. They can still perform phenomenally well into the future, but a lot of the high growth occurs pre-IPO.
So it sounds obvious that you would achieve good returns prior to IPO because you need to get to the scale or the size to be able to warrant that.
Yeah.
However, there's a risk. So the risk is the risk of failure. And that is obviously a key consideration for any investor when it comes to private market investing. So how does that risk get managed and mitigated for any investor?
So if you think about from an investor's perspective, and I'll drop down to from an asset manager to the companies. Now, when you're investing in funds, the manager counts and can make all the difference. So for an investor, you're going to make sure you're investing with a seasoned asset manager that has managed multiple vintages. By vintages, I'd mean like a Fund 1, Fund 2, Fund 3, where they've demonstrated the ability to originate assets, meaning find a business, invest in it, make that business better, exit, rinse, repeat. So you know they've got a track record in doing that. So that's from an investor perspective. From a private equity fund manager perspective, you're building relationships over multiple decades, finding these businesses, and these businesses knowing that you're a good partner with an expertise to help grow their value, add value in their businesses, grow their businesses, help them with strategic guidance in terms of how to manage the business better, get more efficiencies, acquisitions to bolt on, etc.
But it's also surely a nature of the phase of the business. So from a risk management perspective, when a business is starting out seeking seed capital, has an angel investor, expect higher rates of failure can possibly happen. Even Series A, B, C, as you start going through in that regard, there's higher risk of failure. But when you start getting to the growth phase, like you say, where you guys play, that's where you have the opportunity, and that's why guys like you play in that space, to be able to rely on others to find the right deals that are out there. But it's a more mature company at the end of the day. And in the case of buyouts, even more mature from that perspective. So yes, the risk is higher, but it's not exponentially higher, I'd assume. But when you get to angel investing or VC space, well, now you can be in quite a different category of risk.
Yeah, that's spot on. We help businesses get to the next phase. But we also, as stewards of capital, we're very discerning on the companies we invest in. So we want to buy quality businesses that have a strong growth trajectory and strong management teams, because management teams are what makes all the difference in a business. So we want to buy quality businesses, buy good businesses where we can make them even better, and then exit and realize capital, return them to investors.
So I want to come back to the point of exit in the context of the relationship that you ultimately build with these companies, because I think there's an interesting thought there. But we tend to look at public markets versus private and compare the two and say, well, one's more risky than the other, or whatever it might be. And we don't always talk about how the two complement each other from a risk perspective. And I think about it now, especially with the JSE having performed 40% plus over the last year. It's phenomenal. What is the benefit in terms of risk diversification to having private markets in the context of call it expensive public markets?
So investors are attracted to private markets for two key reasons. There's lots of other reasons beyond it, but the key two anchor reasons are: one, they're looking for higher growth opportunities and access to investment opportunities that are not accessible on the exchange. And the other part, it's looking for diversification. So private market assets like private equity or private debt have lower correlations to the public markets, to the listed equity markets, lower volatility. And if you think about listed markets, there's a lot of sentiment that's baked into that drives prices. You know, Benjamin Graham referred to Mr. Market as being the manic depressant. Overly optimistic at times, and other times overly pessimistic. And that creates lots of volatility. And companies can stay cheap or undervalued for extended periods of time, or expensive. When private markets, your assets are priced or valued based on its economic performance, and it takes away the manic depressant factor of sentiment. So you get a truer function of valuation, where we're using the same metrics as listed managers to value a company, being, call it the discounted cash flow model, where you've got a track record of the business, you've got a good sense of its future cash flows, and discounting it by your discount rates that your listed managers would do. So it's very similar. It's just that we have to find these gem of companies, and it takes many years where a listed manager switches on their screen and list of JSE or S&P 500 stocks are on the screen. So quite different in that regard.
Yes, the diversification benefits, I think, are very important that is considered. And I think the regulations, particularly for pension funds, have been relaxed over time to allow pension funds to start investing more heavily in private markets and, in particular, infrastructure. Now, that is also related to our economy and our needs as a country. So can you unpack that a little bit for me? Why have we been allowed more in infrastructure and how much? And why have the constraints around private equity also been released, but albeit not to the same degree?
So it's been for a few reasons. The one is that, as you mentioned with your discussion with Frans Cronje, it's that investing in infrastructure has this multiplier effect on the economy. So a case in point was the renewable energy program. That started about 2012, 2013. It's lauded as one of the most successful programs globally. And that's added, 10 gigawatts or whatever it is to the grid, if not more. And it saved South Africa from maybe 3 or 4 stages of load shedding. Majority of renewable energy projects been funded by private capital. It's been done on a public-private partnership basis with government, but funded by private capital. So there's good opportunities for investors to access returns from those type of renewable energy investments. It also has the benefit for government where our debt to GDP metrics are slightly better at the moment, but we've had rising debt to GDP. And to provide a lot more, to lessen the burden on the fiscus, having private capital invest alongside or fund these projects is very favorable, or it helps the government in terms of the national accounts. Also, it has a multiplier effect on creating jobs. And if you think about it, it's through the value chain. There's been new industries in South Africa that have been created within the value chain of this sector. So that's the one part. The other part is with private equity, it's that entrepreneurs in private businesses are those that create the most employment growth, job creation. And I think we're in an unemployment crisis in South Africa. And I think private capital in businesses play an important role in being able to solve for that.
So I was just about to say, 100% right, it's created new industries and is helping solve for some of the biggest challenges we face as a country, but it's not enough. I mean, that's the reality of it. It's just simply not enough. We still face these challenges. And the average pension fund in South Africa is sitting 2 to 3% invested in private market type investments. So just you didn't answer the question on what are the limits that are allowed, and then I want to talk about the international experience. So how much may a pension fund invest in private equity or in infrastructure?
So in South Africa, post the Reg 28 revision in limits in 2023, pension funds can now invest up to 15% in private equity and up to 45% in infrastructure.
So why so much more in infrastructure?
I think because it's a much needed asset class. It's also a safer asset class because the technology in terms of renewable energy, rail, they tried and tested. And with that, it's a much needed theme required in South Africa in terms of infrastructure assets. And it has multiple benefits in terms of, the job creation that we spoke about and providing more energy.
Okay. So I'm assuming the fact that pension funds are still sitting at that 2 to 3% it's an education gap. It's about finding comfort. It's about understanding. It's about having advisors also lead the investors so that they can have or make good decisions in terms of what to invest in. Someone wrote the other day in the press that private markets was the latest fad, basically implying that it's a marketing game that's going on at the moment, which I dispute.
Yeah.
Simply because of all of the factors that we've been talking about. So how do you find the reception from investors these days? Are they more open, or is there a lot of skepticism that's coming across?
I think there's lots of interest, and I think more and more investors are recognizing the importance of this asset class. And while there's lots of interest, there's also a bit of hesitation because it's unfamiliar. And if regulations allow up to 15%, most pension funds, as you mentioned, are at 3%. Globally, your global P7 pension funds are an allocation of about 20 to 25%. However, in 2012, they were around the 3% mark.
Okay, well, that's interesting, because what it's telling us is that it is about finding that comfort. There's a
Yes.
road to be traveled, Joe, and we need to find that comfort by having transparency, unpacking the uncertainty, and making sure that there's honesty in the representation of what the opportunity is, because there is no such thing as a free lunch.
Yeah.
So, however, there is a luncher, and there's a good lunch to be had, and it's a necessary lunch for South Africa. So I just want to unpack some more terminology that gets used in this private market sort of world. What is a GP? Because a GP is what I go to when I have a cold.
That's a good place to go. So in the private markets world, a GP is a general practitioner, general partner. Sorry, yeah, you've confused me. It's a general partner, and that's been the manager of the fund.
So it's the asset manager.
Correct.
Yeah.
And then you'd have the limited partner, which is the acronym being the LP, which would be the investor.
Okay, so the investor, individual or pension fund, is a limited partner. It's an LP.
Correct.
The asset manager, like yourselves or others that there are in the market, the private market coronations and Alan Grays and so on, is the GP.
Yes, that's correct.
Okay. And when someone invests in private markets, they can either invest directly in the company or the project, or they can invest in a fund of companies and projects, correct?
Yeah, they're investing primarily in a fund where they've got diversification across assets within that fund.
Which is prudent, but what is co-investment?
So co-investment is you've got a fund manager that's looking to buy an asset. It's a phenomenal company, but they don't have enough capital to buy it in totality, and they need capital alongside it. So in that case, where there's this surplus equity available, you'd bring in a partner who can buy in on a co-investment basis alongside you. And that typically comes with many benefits in terms of no fees. So investors who have large exposures to private markets or private equity, often as they progress and they're at more advanced stage, they look at doing these co-investments, which can then enhance returns further. But I think for your general investor and where we are in South Africa, I think a fund is a good place to start. And for those sophisticated investors, which we do have in South Africa, and we've had several conversations with pension funds around co-investment opportunities.
So let's just unpack the way the capital is raised and then invested, and ultimately how the returns are earned. So if it's a fund, you as the GP, the asset manager, would raise capital to invest in that fund. So you would go on a capital raising exercise with a particular date, what they would call a close date. Is that right?
Yes. So in the fund terminology, and these funds are partnerships, in commodity partnerships. That's why you'd have a general partner and a limited partner. So these funds would have a typical life cycle where it would be a fund term life of, say, 10 years with the option of an additional 2 years if more time is needed. So through that, you go through the cycle of fundraising, where they're raising capital from investors to invest in the fund. And then the next part would be on deploying the capital. So the fundraising could be in a window period of 2 to 3 years. And then there's a deployment period where we are asking investors, for instance, if an investor invested R1 billion, and we'd say, well, we're going to be buying, say, 5 companies, and at different stage, we buy them at different stages. Then we'll have a capital call or a drawdown, and we'd engage with you in saying, we need 200 million from the universe of investors to fund that asset. And then you'd move on to, as it matures, to a harvesting period, which is typically in that the sweet spot is 5 to 7 years, and then you'd be looking to exit the portfolio.
So I want to come to the exiting side because it's important that we discuss liquidity. But before we get there, I have to make a joke or poke a bit of fun at the asset management community, because I helped a London-based GP who focused in Africa look for companies to invest in South Africa, private companies that they could take a stake in. And the first time I met with them, I hadn't heard this term, but they spoke to me about their dry powder. And I was like, what on earth are they talking about? But so what is dry powder then for our audience?
So dry powder means you've got capital available to be able to invest in opportunities.
So why did they just say we've got capital to invest in opportunities?
Because I think it's, I don't know the actual etymology of it in terms of where that comes from in terms of having dry powder. I think it has to do with wars and guns, if I'm not mistaken.
Exactly. I think we just all want to be a Maverick on Top Guns.
Yeah, so I think that's where it is. It's to have dry powder handy.
Okay, so you've raised the capital, you've got your dry powder,
Yeah.
you seek good opportunities to invest in. As that develops, you might invest even more. The company hopefully grows, starts producing a return, and now you get to the point of exit, however many years down the line that might be. How do you exit? How does a GP now exit from that investment?
So at the onset of originating an asset, meaning finding an asset to invest in, from that, already at that phase, you're already thinking about ways of how the best ways to exit these. So traditionally it would be in an IPO. That's typically the way it was.
Initial public offer, so
Correct.
listing the company.
Yeah, listing a company, forgive me. And there's been a dry spat globally with that, including the JSE. We've had a few last year, which is great, but there hasn't been, there's been a drought. So you'd look at the company and said, who'd be the likely buyers for these assets, and or these companies, you'd map that out, and you'd know who the potential players are in the various avenues. If it's a strategic buy, which would be typically a big company, where this would be a strategic investment for them to be able to bolster their existing business. So you do lots of those, and of late there have been lots of internationals that want to gain exposure to Africa and South Africa. And this being, call it Africa being the last frontier, so to speak. They want to make sure that they've got some exposure in there which they can grow over time.
But the reality is that there's no place that you can go and just sell. It's not liquid like the listed or the public market. So investors need to appreciate that liquidity during the term of the investment is limited, and liquidity at the end of the term is not guaranteed. It can perhaps take a bit longer or not. Generally, you will be able to sell that investment, but there's no guarantee of anything at any point in time.
Dead right. But with the exit, there's an entire ecosystem that exists in terms of advisors, consultants, mergers and acquisitions specialists, across banks and independents, etc., as well as ourselves, that have been engaging with several parties over decades. So you have this war chest of lots of connections and interested parties that you've dealt with, and you know who are likely buyers of it. So recently we've done a transaction of a unique medical business, which we exited and sold to another private equity company that liked the assets, saw lots of value in it, and we've done very well out of it, and we're keen to exit. And on that exit is when you realize the assets, and it's on realized gains that your investors make your return, because that hits their bank account.
So I think, again, investors must appreciate that as you go through those phases, again, the more mature the company, the higher the levels of liquidity ultimately will be. And when you get to the public markets, well, then, yes, that's the sort of highest level.
Yeah.
And that risk is then fully mitigated at that time. It's a risk, but it's not an unmanageable risk. But again, depending on the stage of the company.
Investments are never without risk.
100%.
And equities, be it listed, you've had equity listed companies go bust.
Yeah.
And it's not uncommon. That happens. There's always one big one that happens every couple of years.
And I think this is where the ultimate appreciation needs to come in. A healthy, burgeoning private markets community or market feeds a healthy public market.
Absolutely.
And where we are aiming to build returns, be it for ourselves individually or be it trustees on behalf of members, you've got to consider the longer term, because you might be investing in lower risk assets right now, but ultimately that might be the highest possible risk if you don't have opportunities in the future.
Yes.
And that's where, again, private markets comes into the reckoning, especially in a country like ours, where we are playing, call it a bit of catch up.
Yeah.
And we do need to build infrastructure. We do need entrepreneurs. We need to create jobs. We've got to deal with a number of issues, and we need the capital in order to do that, in order to create a happy, healthy South Africa for future generations.
100%. And I think, we impact investors, as a business. We invest there's an impact underpin. And if you think about how you develop the country in terms of, call it this pyramid of needs, or how you progress it, it's you want to have good governance to make sure that without governance, it's like building a skyscraper on quick scans. So nothing works without governance. From after governance, you want to have lots of infrastructure that enables economic growth. From there, once you have higher employment, people progress to home ownership. And from there, it goes to education. So we've been investing across that, call it pyramid, to be able to make sure we've got infrastructure that contributes to economic growth. We are able to address the affordable housing crisis that we're in. And then, of course, with affordable, high-quality education. And I think with that, you create this pipeline, and it creates this virtuous circle of a maturing economy or a growing economy. And I think we've got multiple decades before we can be considered a real maturing economy or country that's rolling off.
Well, I think on that note, I'm going to draw this first episode to a close.
I'd like to make one comment on this about responding to the skeptic, your very cynical friend, who says private markets is, I can't remember the term, but he said it's a bit of a fad. So what's not a fad, it's that companies are staying private for longer. And that's why there have been less IPOs. So why they're staying private for longer, it's because managers feel they can execute their long-term strategy far more effectively without the noise of market demands, which are very short-term. So it gives them the opportunity to execute and maintain razor focus on their long-term strategy and vision. So that's one of the aspects. The other aspects is some founders and business owners are happy to be under the radar. But with these companies staying private for longer, you've got this private capital that's been available, and it's available in abundance now, that's able to facilitate and fund these businesses without them going to listed markets. So if you look at that scenario, which is playing out, if you are confined to only investing in listed markets, these great companies that are staying private, you're never going to get exposure to them. And typically they're higher growth businesses.
Yeah, it's such a good point that you make there, because I've thought about it quite a lot in the past, and not really in that context, but the average tenure of a CEO in the States is less than 3 years or something. Or if you take my football team, Man United, the manager gets 6 months, and if they're not winning everything, gets the boot. And you cannot implement and execute on a strategy effectively with such a short-term lens. Essentially, it's simply impossible to do. The market cannot come to you within that period of time, and that just results in a churn.
Yeah.
So it's 100% right. By supporting and giving time, you ultimately increase your chances of achieving a better return.
Yeah, and you eliminate or reduce that element of having a new CEO coming every couple of years, change in strategy, and then you have a business where that they're spinning tires moving fast, but staying in the same place.
Okay, well, listen, thanks for that. I'm going to let you get back to your dry powder. So just to the audience, thank you so much for joining us today. As I said at the start, this is a 12-episode series where we will progress through each episode with different guests and expand on a range of topics related to private markets. And if you go to the www.ebnet.co.za website and you go to ebnet.stream tag, you will see there the Inside Private Markets series and each one of the episodes and what those topics are that we will be covering. And I can tell you that the next episode will be landing on the 10th of February, so in 2 weeks' time from now. And the topic of that one will be the evolution of private markets, both here in South Africa as well as globally. So on that note, thanks again for joining us, and we'll see you on the next one.